Hello, and welcome to our most recent version of our monthly market update. March was certainly an eventful month in the financial sector. While the markets remain volatile and caution is prevalent, the system proved to be able to deal with more tail risks in a way that maybe a few years ago may not have been possible. As a result, performances have remained positive, with diversification finally working as expected, with bonds contributing to reduce the overall volatility in portfolios over the last month. But let's start with the elephant in the room. The collapse of Silicon Valley Bank just a few weeks ago had many fearing a repeat of the 2008 financial crisis. Fears that seemed to be confirmed when Credit Suisse also went into freefall. In fact, both institutions had quite specific problems, and these have seemingly been successfully contained. Silicon Valley Bank was hit particularly hard by the 2022 rate hikes because of its significant investment in mortgage-backed securities. So when it began to seek extra capital, the markets bet against it, leading to the bank's collapse. Nevertheless, the Fed and the US regulators quickly stepped in to protect other American regional banks. The system worked. Which means, fortunately, that March 2023 will be no more than a footnote in financial history, rather than the chapter heading as many feared. So why was Credit Suisse so badly affected? Well, because it already had a reputation for poor risk management. In fact, it might have survived had one of its main investors not expressed a lack of confidence in the institution, which led to a panic and eventually the bank's government-brokered buyout. But again, this was an example of the system working. The fact is that banks in the US and Europe are in much better shape than they were at the time of the financial crisis. While there's no guarantee that the weakest will survive, the data is encouraging. Indeed, portfolios continue their positive start to the year. The collapse in rates obviously benefited the bond sector, but equities also recovered well after the initial crash. It seems that investors have not been overly spooked by the tremors in the banking sector, recognizing the overall resilience of the economy. In fact, it looks like they are betting that the Fed will not raise rates as much as previously expected, largely because recent events are likely to slow down inflation and undermine the rationale for rate hikes. In our opinion, though, unless this optimism is backed up soon by data on jobs and inflation, we could see at least a partial reversal of the latest movements. This has already partially happened, with the inflation data in the US that came in lower than expected, strengthening this narrative and supporting the positive string of returns that have characterized 2023 so far. But it might take some time before we see the markets recover in full. In other words, volatility remains the order of the day, and the window to enter the market remains open. In terms of positioning, we remain constructively conservative. While the crisis appears to have passed for the time being, we continue to favor conservative exposure, and our preference is for inflation-linked bonds and corporate credit. Next week, you will receive our quarterly report that will record a positive quarter of growth for all portfolio lines. It is too soon to say that we're out of the woods, but central banks have built some wiggle room to respond to a recession that might not be as severe as anticipated. Inflation, especially in the US, is today closer to the 2% target than to the peak that it reached last year. All in all, the scenario of a soft landing for the economy and financial markets is still a possibility. In addition to that, the last 30 days has served as a useful stress test. We know that there are still many pockets of risk, and this is one of the reasons we prefer to be cautious, but we can say with confidence that the financial system today has grown larger shoulders to behold the macroeconomic imbalances. Finally, correlations between bond and equities are negative again, and this is great news for all investors choosing a multi-asset approach. That's all for now. Thank you for watching.